Hey everybody, good to be here today. It is Tuesday and time for long options. Glad to be here with you and glad to have you, if you're here live, participate in the chat. Feel free to type in questions. We're going to be talking about hopefully trying to help protect your portfolio today through long options. So we'll get into that in just a bit. But before, there's just a couple things I need to go through. One, let me point out Connie's in the chat, helping me out today. I always appreciate Connie. She's very familiar with what I'm going through. And so as you have questions, feel free to type in your questions between Connie and myself. We'll do our best to get those questions answered. Also, remember that options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only. It is not an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. And for the sake of simplicity, the examples in this presentation may not take into account fees and commissions. Just realize that's something you should think about when you're trading. There's no guarantee an execution of a stop order is going to be at or near the stop price. Past performance of any security or strategy is not a guarantee of future results or success. Paper money software application is for educational purposes only. And there we go. I think that's pretty much what I wanted to go through there on that. So let's get to the Thinkorswim desktop software, which is what I'm showing here. This is the S&P 500. We're up again. We had some rather positive, I guess we'd say, inflation data that came out this morning that has helped to boost the market. In fact, that little high tag right there means we are at an all-time high on that S&P 500 right now. Now, that may dip down by the end of the day. I don't know, but we'll see. Is this going to potentially be a resistance point right here, this previous high? Typically, I don't put that much weight into a previous high as necessarily as a resistance. And the reason is when a stock's trending up, the definition of an uptrend is higher highs and higher lows. Well, if you're in an upward trend, how do you ever get, that's supposed to be high. I totally messed that up. That's supposed to be higher highs, HH, and higher lows. How do you get higher highs? Only by breaking through previous highs. And so you never get trends unless you were able to do that. So any one bounce off there isn't that significant typically. We'll see. Now, if we bounce down from here, then that probably makes that a little bit more of a significant resistance level. Okay, so that's the S&P 500. Now, if you want to learn more about the markets, let me just mention something to you. If you live in the Dallas area, we have a market drive coming up September 20th. Great way to connect, network, and learn more about the markets in the Dallas area, September 20th. And there's still open seats on that. A lot of times our events fill up very quickly, but this one's not full yet. So make sure you check that out. Now, when we talk about options, everybody, this webcast is geared towards long options. But there's kind of three main purposes of options, okay? One is speculation. I'm just going to kind of abbreviate just a little bit. One is income. And by the way, the whole speculation thing is what we typically do in this webcast. Buying long calls, buying long puts, that's more of a speculative strategy, okay? Income, we don't really do that much in this class, okay? Because income strategies are usually short option strategies there. And then there's a third approach, third purpose, I guess, of trading options, and that is hedging. And that's something we don't do as often in this class as the speculation, but that's what I want to focus on today. Hedging, you can hedge with long options, and that's an important function of options. One great thing about options, and there's pros and cons. I'm not trying to convince you to, go out and start trading options if you're not ready or don't want to. But one nice thing about options is they have this versatility to them. Okay? With hedging, what do we mean by hedging? We mean by adding a trade into your account that's going to help to offset either another stock or your portfolio if it pulls back or goes down. Okay, that's what a hedge is. It's trying to help protect you. So we're talking about protection today. That's the goal. Now, is it complete protection? No, it's not, but it can potentially help. There's different means of protection. Some people will use futures to protect a portfolio. Well, we're not talking about futures in this class, okay? If you want futures, we talk about futures on Thursdays. We have a webcast. I said that wrong. On Tuesdays, actually this morning, we had a webcast on futures at 9:30 Eastern time. Okay, but the most common options hedge that people do are what are called protective puts, or say married puts. Married? Why married? Well, the put is married to a stock that you own, and they kind of work together, and that put can help protect you in that. So that's what we're going to be talking about today. When would you do this? Why would you hedge a portfolio? Because there's pros and cons, there's costs, and I'm going to get to the costs, and I want you to be very aware of those as we get to this. But when would you do it? Well, one reason, maybe you have earnings coming up and you're worried about earnings, okay? That could be a reason why maybe you'd hedge. Put on I may say hedge, but for our purposes today, we're talking about protective puts, okay? Maybe there's, we'll say, in addition to earnings, there's other news events that could affect it. Maybe you have an individual stock that has some merger news or something like that you're worried about, or FDA approval, it's a biotech or something like that. That could certainly affect it, or a lawsuit or something like that. Or maybe there's news on more global or macro news, maybe tariff news or something like that makes you worried about things. Maybe there's an economic report coming out that you're worried about. That could be a reason why some people hedge at different times. So basically what it comes down to, though, is any uncertain situation is a reason that you may consider hedging. Now, could one of those uncertain considerations be, hey, the market seems kind of frothy? In other words, the market seems overbought. It's gone up so much, you kind of expect a pullback? Yeah, that could be a reason. Now, keep in mind, you don't always have to do a long put to hedge there. You could just, like, if you have a exposure in the market, you could limit your exposure in the market. You could sell a stock, right? That's certainly a way of taking off some risk. But these are all reasons why you may put on a hedge. It doesn't mean your hedge is going to be a permanent part of a portfolio. Now, Prakash said, what about a collar? I'm going to address collars here a little bit later today. Okay, we'll address collars. Some of you have heard of that term collar here. I'm not going to necessarily do a collar trade, but I will address the collars because it's pretty closely intertwined to the protective put that I am going to be talking about there. So we will get to that. Now, so that's when you may do it, but just realize there is some cons to it as well. One, if you do a long put, the long put is subject to time decay, okay? Time decay. That is, it's a negative theta trade, a long put. That means even though your stock, you can just hold a stock as long as you want, and there's no real time decay on it. I mean, the stock may go up or down, but there's no time decay element on it. Once you throw in a long put, everything else being equal, there's a little bit of time value decaying out of that option every day. That means if the stock doesn't go anywhere, you're actually losing some money on that protective put. Okay, and keep in mind, when you buy a put, that's what we're talking about. We're talking about, when I say protected put, we're talking about buying a put, doing a long put. You can lose the whole shebang, not the stock, but I'm not talking about losing value in the stock. I'm talking about you can lose the whole put. Okay, now technically you can lose the whole stock as well, but that's a different story here. You can lose the how do I say it? The whole value of the put. Okay, the whole value of the put. Puts can go to zero, and all options, you know this, options are volatile, and so that's certainly a problem there. Okay, and here's another thing, and it's kind of related to these other things. You know, the time decay works whether the stock is going up or down, whether the put is going up or down. Time decay is an element there. You can lose the whole value if the stock goes up, say, or let's just say the put never goes in the money. You can lose the whole value of that put. Okay, but let's say the stock goes up. What does that mean? What's the ultimate result of that? It means it's going to eat into the gains. If I have the SPX, let's say I have own a portfolio and I put a long put on the SPX, then and the SPX goes up or the portfolio goes up, well, I'm going to be making less money than I otherwise would because of that upfront cost. So those are some of the cons of those long puts. Let me give you an example of this here, and then we'll talk about actually putting some in. Because in the past, I have added in this portfolio a long put, actually 2 contracts, of a put on the XSP. What's the XSP? The XSP is an index option. I talked just a minute ago, I alluded to possibly doing SPX options. Well, XSP are other index options, and they're basically 1/10 the cost, 1/10 the movement of the SPX. So if SPX options seems like, wow, those can be pretty expensive, they can move a lot, they can affect your portfolio a lot, these tend to affect your portfolio less. And so I put in 2 contracts of XSP put options, and this is going to illustrate some of the risk I'm talking about. How's this done? We're down $1,146 on this thing. Okay, not so great, but you know what? The purpose of this wasn't necessarily to make money. The purpose was to hedge. Okay, so let's talk about that. When did I put this in? I actually put this in on July 1st. Okay, is when we entered this trade. And what happened? Well, let's just look at the SPX here for a sec. Okay, the SPX July 1st was right here. Okay, so we were right around, we'll just say under 6,200. Okay, it's actually, well, we'll say 6190. 6190 was the value of the SPX on July 1st. Now we're at 6438. Okay, that's kind of real time here. So we'll look at that. So I'm going to take and see how much we've gone up during that time frame. And you can see why we've lost some money on our hedge. 6438 minus 6190 gives me $248, 248 points on that. If I look at my portfolio, and I'm just going to beta weight this to the SPX, and if you want more information on this, I did a webcast on last Friday, just this very past Friday, a few days ago, in my advanced options webcast on beta weighting a portfolio. Okay, but what I can do is I can look at this and say, oh, you know, for each dollar move in the SPX, my portfolio is affected by about $37. So if I take that $248 move in the SPX, and this is just an approximation, this isn't going to be exact because delta changes over time, and delta changes as the underlying goes up or down. But if I take that $248 move we saw and multiply that by the 3743, I'm coming up with Did I do that right? That sounds like a lot. 248 times 37.45. Yeah, $9,000. Okay, $9,000 on this. So in other, oops, let me just do this one more time. I just did a bad click there. Okay, all right. So during that time, assuming my portfolio was the exact same as it is now, and it wasn't, or whatever, but I made the portfolio would have gone up about $9,287. Well, this portion here actually was a loss during that time of 1146. Okay, so actually, how much would I have made if I didn't have the hedge on? Well, I would have made, I don't know, what's that? Roughly, let's see, $10,400 or so. Okay, so when I talk about eating into gains, yeah, this can eat into gains in a significant way. Of course, if you knew without a shadow of a doubt that the market was going to go up, you would never have put the hedge on. But the point is, you don't know. I don't know. We never know what the market's going to do. This was there to protect us. This is like, this is not an insurance product, but I want you to think about it this way. Anytime you were to buy insurance, you're not expecting necessarily, it's there to protect you. This is not insurance, but it is here to protect you when you're doing a hedge on that. Okay? And there's a cost involved in this. And this is a substantial hedge. You can do smaller hedges, you can do bigger hedges. This is a pretty big hedge. So that's just an illustration of it going against us. Now, I only have 2 days left on this. So you know what? It's time to get this off. This expires, 3 days to go on this. It's time. I'm just going to get out of this trade. And to get out of the trade, you can just simply right click. For some reason, my right click was not working very well, but we'll try that again. There we go. And I'm just going to get out of this. Confirm and send. And we're going to send that on there. Okay. So there we go. I'm going to get out of that. I actually could have stayed in that. I didn't get much money out of it selling it. I could have left it on for 3 days, but the odds of this gaining much value in the next 3 days, it was a $600 strike on that, on the XSP. That would be way down here. That'd be quite a crash there. But I could have certainly left that on. Okay, so that is an example of a hedge that didn't go very well in the sense that the hedge itself didn't show us a profit, but it did its purpose. It was there to protect us. Now, when you are doing a hedge, how do you do it? You can do it on trying to protect the whole portfolio if you want, like we did with the XSP, or you could do it on the NDX or the RUT if you have a portfolio that's a big small cap portfolio, or the SPX, which is kind of like this, but bigger, I guess, in a sense. Or you can hedge individual stocks. Regardless, very often in this webcast, what I encourage people to do, just for our purposes here, is to look for something about a 30 delta. Okay, roughly a 30 delta for, if we have 100 shares of stock, we're going to look for something with about a 30 delta on that. Okay, why 30 delta? Why not more? Well, the answer is we're trying to balance between the cost of the hedge and the protection. And we're going to get into that just a little bit more in just a minute. We're trying to balance the cost and the protection. And one thing to realize is there's an option Greek, a lot of you have heard of it, called gamma. Okay, and what it means with long options is the more it goes in your way, the higher the delta goes. So if I have 100 shares of stock and I start out with a 30 delta and the stock goes, well, the stock goes favorable to the option, and if it's a hedge, that means stock's going against you, then that delta is maybe starting with $30. We may be starting with 30 delta, but that delta is actually going to go up. Let me give you an illustration of that. actually. Um, let's do this. Let me look at another stock I have in my portfolio. I have AVGO in my portfolio. Okay. Now, of course, one choice I always have if I want to try and help my money management, my risk protection, is I could put on a stop loss on there. That's typical. Now, stop losses aren't guaranteed, and there is certainly a big difference between stop losses and protective puts. AVGO could gap way, way, way down, and the stop isn't going to get me out necessarily, where I want it to get out. And I'm going to be showing a big, big loss on that. Whereas if I have a protective put on, even if AVGO gaps down, that protective put is going to offer some protection there on that. Okay. So, but just realize there's other money management things on there. Now, the nice thing about a stop loss, I gave you some of the bad things. They don't guarantee you to get out at a particular price. You'll get out, you just don't know where you're going to get out. But one nice thing about the stop loss is it doesn't, there's no time decay on a stop loss. You're not losing from that matter. Okay, so so if we were to look at AVGO and say, I want to put on a protective put here. Well, let's do this. AVGO has earnings coming up in early September. So I'm going to go to trade. I'm going to pull up AVGO. Here's AVGO. And so I'm going to go, we'll go 19th of September. Okay. So I'm going to look here and I'm going to look at the puts here and I'm going to go to something around a 30 delta. Here, we've got this one, the 290 put may be one that we'd consider for this webcast. 29 delta. So what does that mean? It means if AVGO moves $1, we would expect this put value to change by about 29 cents on the dollar, okay? But here's the thing. AVGO right now is approximately 310. If AVGO were to go, say, down about $20, okay, that's less than 10%. That's like, what, 6-7% or something like that. If AVGO were to go down to about 290, we'd expect the delta to probably be about 50.50 in that. So in other words, it's no longer giving me 29 cents of protection per dollar at that point. It's actually upping its protection to about 50 cents on the dollar. Does that mean if AVGO drops a lot, I'm going to be totally impervious to loss? No, because even if it drops 20 bucks, we're only protecting half the cost of it. But as it goes down more and more, that delta would tend to go up and up. Now, in the case of a put here, when I say delta going up, I'm talking about the absolute value of that, that's a negative value. In other words, my gamma right now tells me for each dollar move, we're looking at approximately a 1 penny, 1 cent or a 1 point move, 0.01, I guess, move in my delta. Okay. 0.01 move on my delta there. So let's see that. So that's what that is. That's how the gamma works. This is if AVGO moves down, we'd make a negative sign on that gamma, and that would actually add up here to my delta. Okay, so these start to be more protective the more the stock goes down. Now, I said maybe we do something like this 290 call. This would cost us about $925, roughly, just using the ask price there. Now, let's say we want to do more protection and we go to the 65 delta. Yes, that's going to give me a lot more protection, but that's going to cost me nearly $3,000. So when I say I'm trying to balance between the cost of the protection and the amount of protection, that's what I'm talking about. 30 delta is not a recommendation. It's just a balance between the two. If you want more protection, you can move up that delta, but just realize it's going to cost you more. Okay? It's going to cost you more on that. All right, let's go and let's look at, well, let's do a stop. Let's do a protective put on this. Okay? So I'm going to do exactly what I said. I'm going to go to here, and to buy a protective put, I'm just simply going to click on the ask price. Okay. Do I need to put on a stop? No, I'm not putting a stop loss on this. Remember, this is going to be a married put. It is going to go in concert with the stock itself. Now, I want to talk about callers here for 1 sec. Okay. I'm going to send this in just a minute, but before I do so, let's just talk about this. Sometimes you'll hear people talk about callers, and it's certainly a valid option strategy. It's not one we cover in this class so much because this is a long option class, and a caller entails another element. It does entail the long put, okay? It entails you own the stock, you buy a long put, and then you sell a call. Let's say we were to sell this call right here, this 330 call at the same time. Well, we're paying about $920 for the put. With the call, we're bringing in about $965. So in other words, the call offsets the cost of the put. Hey, that's nice. Okay. That's very nice. Also, remember, one downside on the put is you have a negative theta. Time decay is working against us on that long put. What does the short call have? The short call has positive theta. Okay? It has positive theta. So they offset each other to a large extent at least. And so it gets rid of that detrimental impact. But, and this is a big but, okay? There's a huge difference in this trade. In this short call, just like any other covered call, for example, you're capping your gains. If my theory is AVGO, Broadcom here is going to keep going up, this is going to cap our gains. What's our delta on this? Well, our delta is going to be, look, we had about a negative 29 delta here, but we're also throwing on a negative, because we're selling it, 36 delta on top of that, okay? So we're really limiting the potential gains on the stock there. Furthermore, if the stock goes up, this delta, because this is a positive gamma trade, excuse me, this is a negative gamma trade here, this delta is actually going to go up in this case, in the case of the calls. So we just limit ourselves out at that 330 level there. So protective put offers protection. Caller, it offers protection, some other benefits, but it also caps your gains. So you got to decide whether you want to cap your gains on the caller, okay? Because keep in mind, if I'm just going to cap my gains, I may just consider exiting the stock, exiting the underlying stock. So I'm not going to make a decision for you on this, but just as long as you understand the pros and cons of those trades, of the two, okay? I'm hoping that answers questions there. Let me stop just 1 sec. We'll do one more example here, but I want to see if there's any questions that Connie was not able to get to. Okay, this was originally from Prakash, who said, what about a caller what about a caller? Do a call at a higher price and date and put, yeah. So there's little variations you can do. You can choose different strikes. You can choose different expiration dates. Just know the pros and cons of those. So there we go. Let's see. Masood, looks like Connie helped you out on that. XSP options. XSP options can be liquid. You got to check on the individual one that you're looking at here. So XSP options. I mentioned those, and you can look out and see what we got on whatever date you want here, and you can go here and you can go volume open interest, and you can see here's your open interest on those. It's hit and miss, depends on the contract there. There. I don't, to be honest, and this isn't just for long puts or protective puts, this is for long calls as well, or any other option trade. I focus less on the volume. Remember, that's just today's trading activity, more on open interest, bid, ask spread on those. But you do need to be cognizant of that. Certainly, forgot what I was going to say. I lost my train of thought. Let's do AVGO. I know what I was going to say. Options on XSP are not going to be as liquid as SPX options. Why is that? Because SPX options are very, very commonly used by institutional investors, okay? Very commonly used by institutional investors, which can certainly drive up those volumes there. Okay, so here's AVGO, and I'm just going to do what I said I was going to do before, and that is I was going to do a protective put on this, if I can get the right one. We were going to do the 290. It's just a long put, natural price. Maybe be able to get a little better than that. We'll do that. I'm going to confirm and send, and we're going to send. Okay. So now when we look at this, what's my net delta on AVGO? My net delta on AVGO, let me not beta weight it here, is, drum roll, well, it's going to be basically the difference between the 100 and the 29. There's my net. So I made this a little bit less of a bullish trade there on this, but helps to protect a little bit. Okay, so let's do another one. Let's do another one. Yeah, so going back to the caller, Jack said that would still be a decent gain even if it's kept. Yeah, absolutely. I mean, if we did what do we say? The stock is at about 310 right now. If the stock went up to 330, which is I think where we were looking at the short call, yeah, it would still be a gain here on that at that point. So it's just, you guys now are empowered, I hope, to make the decision, because I'm not here to just give you a formula. I'm here to let you understand it so that you can come up, because there's, all these different pros and cons of choosing strike prices here. Let's look at another one here. Let's look at Bank of New York Mellon. Again, I don't have a stop here. I could put a stop loss on this. We had earnings not too long ago, because that's one that came out at the beginning of earnings season. But again, I have a pretty good gain here on this. So one thing you may do, if there's no news event, you may go, this has been trending up. So if you're a trend trader, you may remain bullish on it perhaps. But it's had a pretty good run. Would it shock you to see this, go up and then go down a little bit, or, so that'd be kind of a shorter term flag, but also if that flag turns into something worse, that can offer us protection. Now, just because we have a protective put doesn't mean we're eternally bullish on the stock, because we're going to lose more money on the stock than we do make on the protective put, okay? And so, because remember, we're starting off with something probably like a net 70 delta. In other words, the stock, 100 shares of stock is 100 delta. If we go with that 30 put, it's going to be like a negative 30. So our net is about a 70 delta. And that will change a little bit, as I mentioned before. But this is it still means if the stock goes down and really goes down, we may suffer a little bit on that trade. And that's why you may very well say, look, at some point, I'm going to get out of this trade. Maybe it's a broken support level Okay, maybe it's that broken support level. And you can define your support level different ways. You can use, this is a 50-day moving average, this blue line that I'm kind of marking up right here. Maybe break below that. I'll get out of that trade. So you can do that. Let's do the same kind of formula we did on the others. Okay, now, what about a vertical put spread? You could do a vertical put spread. Yeah, you could do a long put vertical, but you're offering less protection. Remember, a long put, even if we do it out of the money, is going to give me that 30 delta. Let's say I do that put spread. I don't know what the delta is going to be. It's going to be the difference between the deltas of my two strikes, but my delta may be down somewhere in the 10 range or something like that too. So pros and cons, right? Pros and cons. Let's go to here. And what did I clicked on active trader. I don't want that. Here's BK. And I'm going to go out a little longer term on this. Now, the consequence of going out longer term is that my, it's going to cost more. Okay, let's say I go 45 days here. Okay, spreads are a little bit wider. That's because these are weekly options that just came out recently. Okay, so my spreads are not that spectacular on that. Let me go to, I can go to 38 days. Okay, that's not that much. That's the same, I think, expiration we were looking at before. I can go out to 129 days, which is a really longer term protective put. And my spreads are probably going to be a little tighter on that. I can still go out here. It's going to cost me about $320 for the protective put. Okay, if I go to something close to that 39 delta. Now, you may go, well, $320, that's a lot of money, or maybe it's not a lot of money. But remember, I have 100 shares of stock of this. That's over a $10,000. I have over $10,000 worth in this paper money account of Bank of New York Mellon stock. So $320 may not be unreasonable to spend on the protective element on that. So that's what I'm going to do. I'm going to click on my ask price. I'm going to put this in. I'll put it at in between the natural price and the mid price. I'm just going to do one contract, and I'm going to confirm and send, and I'm going to send that order. Now, if I want to get out of these, one thing I can do is, of course, I mentioned I could put a stop on this. I don't have to put a stop on both. Okay? It's not also a lot of times with like covered calls, because traders don't want to be left with a naked call sitting there. If you sell the stock, to put the exit on, you'll get out of the stock and the call at the same time. Okay, and you could do that. You could put a trade to get out of both of these at the same time. But if the stock is going down and he gets stopped out, let's say we get rid of that, and just that, hey, at that point, we have a long put that's probably doing pretty well if the stock dropped and got stopped out. So there's no need to put in the stop, to put an exit on both of those at the same time. You may want to, but you don't need to. Okay? All right. So here's the thing. I'm gonna wrap it up here, but let me just kind of summarize. Most weeks in this webcast, we talk about more speculative strategies, trying to take advantage of a stock moving up or down. Here today, it was more of a protective strategy, this married put, this protective put. And we're going to, it's here to hedge our portfolio. They're not necessarily meant to be permanent additions to a portfolio, because there is that cost. There's that time decay that eats into your portfolio. And in the long run, historically, stocks have gone up over time. And so you kind of hate to put too big of a headwind into that. But at periods of time, you may deem it important to try and protect a portfolio. Maybe that's an earnings event. Maybe it's other news. Maybe it's just an overbought type state. Always remember, you can just exit out of the individual stock if you want. And you can also do the protective puts, as I showed you on the a broader index like the SPX or the INDX or the XSP or something like that to try and help protect the overall portfolio. Okay. So that's what we did today. All right. I want to thank you for joining us. I want to thank Connie for helping me out in the chat. Coming up next, we've got, I should remember this by now, getting started with technical analysis. Okay. Getting started with technical analysis. Make sure you check that out. And thanks each of you for taking some time out of your day to join us. Make sure you subscribe to that Trader Talks channel on YouTube so you don't miss future content. Everybody have a wonderful rest of the day and week ahead. We'll see you same time next week. Bye-bye.